everyone. Welcome to episode 3 of Word on the Street, presented by Warren Street Wealth Advisors. My name is Philip. I'm one of the co-hosts of the show, also a portfolio analyst. And with me, I have Blake Street, the one and only Blake. He has many titles, but today I'll just go with Blake.
I like that. Keep it simple.
Keep it simple. Today, we really just wanted to talk about 2021. The title of this episode is Year in Review. So we really wanted to go over some of the key themes that we saw last year because, it was a heck of a year. And then we wanted to just touch on, what are some things that we're keeping an eye out for in 2022, right? So with that said, I think we can jump right in. So I think it's good to first look at some perspective. I mean, so far right now, if you turn on the news, chances are you'll see a lot of COVID-19 related data, right? And sometimes that can be a little bit discouraging. But we like to share just some perspective as to how far we've come, right? And we'd like to do so by looking at a few charts. The first chart on the left that you're seeing is TSA traveler throughput. How many people are being processed by the TSA on a daily basis, right? In other words, how many people are still flying? And you'll notice that we have shared this chart a few times, but you'll notice that going back to November of 2019, you had almost, let's call it 2.5 million people flying on a daily basis. Come the COVID-19 drawdown, that dropped off so quickly, right? It was almost as if nobody was willing to go on a plane. And I don't know if you've been on a plane ever since.
I have not.
You have not. Sorry.
I feel like if I didn't have 2 kids 2 and under, though, I probably would have flown at this point.
Wow.
The itch is there, but traveling with toddlers and newborns is generally difficult to begin with. Doing so in a pandemic just sounds like a total non-starter. Have you flown?
I have not gone anywhere. I've been stuck to not the basement, but stuck to my little corner of the room. So just trying to make.
You've got a different kid to watch over, and it's the CFA. You're studying morning, noon, and night, I imagine.
Studying all day, every day. It's
I don't envy you.
But I know, I mean, we haven't been on flights, but that doesn't mean that the rest of the world hasn't taken any flights. In fact, we can see that, starting in 2021, so early this time last year, the TSA travel throughput data really picked up and people started, packing up their luggages and getting on planes. And that data has remained persistently high. And you can see that still today, about 1.5 million people are going on flights.
Yeah. Material drop off just due to Omicron. I mean, some of that was, unwillingness for folks to fly, but also just constraints within the workforce, within the airline industry, not being able to staff their flights and canceling flights last minute, which is a deterrent on bookings and things like that as well. So, however, I mean, right before the Omicron wave, people were getting back to it. They were traveling, and I expect that theme to continue as soon as this wave kind of tapers off. So it's a matter of supply and demand equilibrium kind of getting back in place. But yeah, I'm pretty impressed. Pre-Omicron, obviously, a little bit of a pause button here.
Yeah, exactly. And now let's talk about not what's going on in the US markets. Let's take a trip overseas, right? And it's really hard to talk about 2021 without talking about emerging markets or these developing nations, specifically China. So within China, you have a lot of volatility, right? And that can be attributed to a number of reasons. That could be crackdowns on monopolistic competition, data and privacy concerns. You have their goal for achieving this thing called common prosperity. You want to touch a little bit more, Blake, on what some of these things are and some of the drawdowns on the chart we're seeing?
Yeah, I think one of the reasons why it's hard to talk about 2021 without talking about China is we as a firm have always had a willingness to, ignore home country bias, be geographically diversified across the globe. It's hard to do that and to ignore China when building international allocations. Emerging markets broadly and China broadly had such a strong first quarter of 2021. And there was a lot of, premature celebration going on, which was like the emerging markets are waking up, international investing is working. And then pretty much the remaining 3 quarters of the year, that was, all vaporized. China specifically, I mean, you'll hear us kind of wax on and on about, thinking that the most recent sell-off is overdone, but the things that were causing it were material concerns. So like you just alluded to, stuff like common prosperity mandates of, breaking up monopolistic practices and sharing the distribution of wealth and opportunity across different industries and companies. Privacy concerns, delisting risk here in the United States was obviously a big one with a lot of the Chinese tech darlings having IPO'd on US markets. Those outcomes aren't binary. It's not like as if something goes US IPO and then delists and trades on the Hong Kong exchange, it zeroes out. It is disruptive. It is concerning. And all of those things kind of rolled into one. It was a really, really tough year for Chinese equities. Throw on top of that the draconian kind of lockdown measures they had and still have to this day to get past the COVID global pandemic. It's been a rough stretch. However, looking forward 10, 15 years, it's hard to not think of China as an investable universe or an opportunity set. So, on the chart, you see some of the biggest darlings, Alibaba and Tencent, having really, really material down years. I think Tencent finished down about 41%, Alibaba down about 56%. That's a really stark contrast to the emerging markets at large, which actually were only down about 3%. And then excluding, the emerging markets total down 14%, excluding China only down 3%. So if you take China out of it, emerging markets weren't necessarily as negative of an outcome. Relative to the US markets, obviously there was still a huge divergence in performance. But you have to really ask yourself, recent sell-offs in China, did those include regulatory pressures? How did the market play out on a go-forward basis? Long-term, do we see some of these headlines getting worked through, some of these global kind of geopolitical tensions getting worked through? And I would argue yes, but obviously last year, really, really a tough year for China.
Yeah, absolutely, Blake. And we are going to touch on that. So yeah, but I agree with everything you said about China. I think the interesting thing is, hey, emerging markets ex-China only down 3%, emerging markets with China down 14%. So look at that difference, look at that delta, and understand that, hey, a lot of the emerging markets risk that we've seen has been attributed to China, but what is our go forward outlook? And again, that's something we will touch on. So it's also hard to talk about 2021 without talking about how I feel every time I go to the pump. And I swear gas prices, not just gas prices or restaurant prices across the board have definitely gone up, right? And sure, that could be a byproduct of it's the year after 2020 when the pandemic first announced and people want to go out and do things, right? So there's this huge excess demand, but there's also excess demand created by liquidity injections, things like asset purchases, the Federal Reserve buying back mortgages, lowering the short-term interest rate to make your car loans and mortgage rates, go down significantly in order to kind of fuel and funnel the economy, right? And that in turn has led to inflation, right? And what we see on the chart here is 7% year-over-year inflation in our most recent report. And that's the highest we've seen over the past 10 years. So I don't know, Blake, what's up with inflation?
I think we got what we asked for. In a lot of ways, when we were staring down the barrel of COVID at the beginning, certainly you could argue for a very, very deep recession, if not depression. And then hindsight's 2020, but at the time, no one knew how bad this thing was going to get. So we pulled out all of the liquidity cannons that existed. So whether you're talking about, PPP loans and EIDL, Treasury getting involved, and that, like you talked about, asset purchases, mortgage-backed bonds being bought, direct payments, transfer payments to consumers, just anything under the sun to get people spending, get people comfortable, get people to a point where they could stay at home and prioritize kind of the public health response ahead of everything else. We did that knowing at some point this is going to translate into some type of inflationary pressure, whether it becomes materials pricing pressure or inflation, wage inflation pressures. So again, we kind of got what we asked for. In addition to that, just the money supply creation. You kind of have to ask yourself, was it worth it? Did we stave off that deep recession and potentially depression? And now are we willing to live with the consequences, and do we have the tools ultimately to address it? So I know we'll be talking about this more in a bit, but I would argue that, yeah, it's kind of like thinking about the global financial crisis and all of the stimulus spending and TARP and things that went into getting us out of that more quickly. The Fed, the central bank, even in fiscal policy response perspectives, there's a responsibility to stave off deflation, to stave off depression, to stave off recession, and to accelerate kind of supply and demand reaching equilibrium faster. So we got what we asked for. I mean, some people are acting surprised. I'm not really surprised. I know there's a heavy debate out there going on as far as, have we peaked? And I've heard a lot of really smart people saying that we're kind of reaching the plateau or the upper echelon of where they think inflation will go. I'm not that smart, and I certainly don't have a crystal ball, so I don't pretend to predict it in the near term, which is why we diversify and own a lot of different stuff. So yeah, I guess a lot of words to say I'm not surprised.
Well, I feel like you're not surprised until you're surprised when it costs you and then one episode you're talking about buying milk gallons.
Yeah, I mean, $10, I think, for a 2-gallon jug of organic whole milk.
That's ridiculous.
Yeah,
that's insane.
And by the way, you just need to drive a Prius, and then the pump won't bug you as much.
Exactly, or get a Tesla. I don't know, maybe. That's expensive though.
Yeah, there's a different kind of inflation.
Exactly. So capping off our last theme for the year, we just wanted to take a look back at broad asset class performance, right? What did well and what didn't do so well. And towards the right, I guess we can start with the leaders. US real estate in the publicly traded form, or REITs, they blew everything else pretty much out of the water. Second to that was US large growth. But I think before I go any further, I want to paint some perspective from the start of 2021 up until the end. So at the start of the year, we actually saw international stocks outperform US stocks. We saw value stocks outperform growth stocks. That was up until about midway through the year when you saw this Delta resurgence. COVID cases started to uptick again. And that's when a lot of investors started to return to those work from home type of companies, right? And that's when you started to see US large growth kind of take the flag back. And they essentially ended the year beating out US large value. And you can use that proxy for global growth and global value as well. But yeah, those are some of the leaders. I don't know, Blake, if you want to add anything there or comment on some of the laggards.
Yeah, I think just generally speaking, kind of thinking left to right, gold, we talk about it as the roadkill. We keep poking it, trying to see when it will come to life. We talked just a moment ago about inflationary pressures. There are a lot of things that have gone on in the last 2 years that should bode extremely bullish for gold. Low yield environment, inflationary pressure, money supply creation, et cetera, and it's not really gone a whole lot anywhere. I've heard a lot of people opine that cryptocurrencies and Bitcoin in particular have become the digital gold, and it's taking off fund flows from gold. So that's probably the biggest surprise last year, just given kind of all the macro play that was in front of us. Bonds, obviously tough yield environment. The broad asset classes obviously struggled. Thankfully, a lot of our fixed income managers actually had a pretty darn good year. It's probably the strategy where our results shine the most. And then to the far right, I can't say that I was surprised that US REITs had a big year. They directly benefit from a lot of the liquidity kind of injections that were at play. They also got their butts kicked early on in COVID. But they also benefit from cheap leverage and borrowing costs and a return to normalcy. And I think there's a lot to be learned about commercial real estate and publicly traded real estate at large over the next couple of years as we move kind of beyond the post-COVID normal or into the post-COVID normal. But the actual surprise to me is just the continued strength of US large cap growth. So like you talked about, kind of the stay-at-home narrative and some of the large mega tech names continuing to eat everyone's lunch. How long can that persist and or last? It does until it doesn't.
Yeah.
And there are some names in there that flash extremely expensive, and there's also some that look, reasonable at the same time. So it's kind of dystopian in a way. The underbelly of the growth market, obviously, we're seeing it play out in front of our eyes right now. Like we're talking about last year's results in growth. I think the same index is down double digits year to date, 20 days in, 20 days plus.
Exactly.
Real estate's down 10% plus 20 days in. So it's not all sunshine and rainbows. When you inject a ton of liquidity and pull a bunch of growth forward and artificially inflate asset prices, eventually the other side of the coin shows its face. So I feel like we're surprised every year on both sides.
I think I'm starting to see a trend because, we always say past performance is indicative of future performance, right? And in 2020, so not 2021, in 2020, gold was probably the top performer. And this year, it's the worst performer, right?
Or last
year, excuse me. But might be a similar story for US large growth and US real estate, right? I mean, last year, they were the top performers. This year, so far, 20 days in, not doing so hot. So we'll have to see if that continues, but
maybe that's our only investment strategy going forward. Year to year mean reversion. Buy the dogs, sell the winners. I like it. Not investment advice, just
exactly. But that's kind of a recap of 2021. Now we want to transition into what we're keeping an eye out for the year ahead. And the first thing we want to talk about is COVID. And I know some of you might be saying like, oh, I've seen and heard enough of this already. Every time I turn on cable news, you mentioned in this, but we wanted to share kind of a different perspective. So the chart we have in front of us shows for each metric, the percentage of that metric's peak value in early 2021. And I think the takeaway here is, even though confirmed cases towards the right have just ballooned, hospital admissions, patients in ICU, confirmed deaths, they haven't shown as much of an uptick as confirmed case counts. Compare that to the waves in the first and second and third wave beforehand, they were pretty much right on top of each other, if not, very, very close. So I think that goes to show a number of things. I don't know, Blake, if you want to jump in here, kind of tell us what your thoughts are.
Yeah, I mean, I think we're all in the mood for some good news, or at least most of us are anyway. Omicron variant, albeit very transmissible, has certainly proved, at least per capita wise, to be a lot less lethal. Some of that may have to do with the variant itself. I'm by no means an epidemiologist, but at the same time, it also has to do with the level of vaccination within this country, the way we treat it at the frontline level, natural immunity, masking, social distancing, all kinds of stuff. So encouraged by the fact that even though we've had 4 times the case counts, we've had 1.5 times the hospital admissions, relatively similar patient ICU counts, and deaths have seemingly kind of plateaued. I think there's a little bit of a TBD or asterisk there. But it seems like we get a little bit better and better at dealing with it, both on just an immunity level and also just a societal level. So it does appear, I know I was listening to that first podcast this morning, that a lot of the areas first hit hardest by the Omicron variant, like the DC area and Rhode Island, are now starting to see their case counts kind of come down as aggressively as they were starting to go up. So hopefully this wave, 6 to 8 weeks time from now has come and gone, and we see where we're at and we go from there. Larger herd immunity, maybe a little bit more of a nudge for folks to get vaccinated if they're still on the fence. And ideally less supply chain disruption and things like that. So I know we're all looking for things to kind of feel good about. And I think there is some things to feel good about in this current wave.
Absolutely. So earlier, we also talked about China, right? And even though 2021 has been a bit of a rough year for China, Blake's, like you said, you're a China bull. That default makes me a China bull. No, I'm just kidding. That I personally share the same conviction as Blake. And there are a number of reasons why, but I wanted to paint some context as to why we continue to remain confident in China despite that drawdown we shared earlier. So what this chart in front of us shows the MSCI China index, and you'll see that and this is spanning from March of 2009 all the way up until pretty much January of this year. And you'll see each of these orange lines represents a drawdown of north of 30%. And you might be surprised to hear that every single time there was a drawdown north of 30%, that had to do with regulatory pressures. So similar to what we've seen in the 2021 drawdown. And you might be even more surprised to find that even though there was a drawdown from those regulatory crackdowns, the 12-month rolling returns, the 24-month rolling returns, or what returns look like 2 years after that market bottom, and even the 3-year rolling returns are all positive. They're all in the green. So I think this kind of teaches us a lesson about volatility in China. I don't know, Blake, what do you think? Would you say volatility is normal experience as a Chinese investor?
I think volatility is normal for any equity investor. It's kind of risk begets return. If you're invested over a market cycle, you're gonna feel some semblance of downside or volatility. We could talk all day about the macro things, the demographics, the pace of innovation, the valuations, like all the reasons why we like international, why we like emerging markets at large, and specifically why we like China. But if you start with like the principled place of, I'm a globally diversified investor, right? And I don't want to own my entire nest egg within the home country borders that I was born in. You then start to build allocations elsewhere, right? And then on an ongoing basis, you have decisions. I save money on a regular basis, or rebalance my portfolio, or I want to be tactical and take advantage of a sell-off. You're looking for perspective or history to teach you what is a good time to be doing those types of things. And so I think this chart just really goes to show that, like, during these long, drawn out material 30% plus drawdowns, how have I been rewarded 12, 24, 36 months out? And in all cases, in these most three recent drawdowns, you've been rewarded well. And the numbers are positive, they're green, and they're relatively large. That's actually in a decade where investing in China has been not a good play. So even in the midst of, a decade of underperformance and dissatisfaction, timing still helps, right? Like, when are you running rebalance files? When are you adding cash and getting back to target? So there's how do you tune out the signal from the noise? There's plenty wrong about China. There's plenty right about China. But if you still believe in just being globally diversified, it's a market that you can't. It's like roughly a third of the emerging markets, and depending on how you measure it, in some cases more. You can't ignore it. So if you have to build an allocation, you want to build an allocation to it, typically you want to hold your nose and do so during these drawdowns.
Exactly. And next, we also want to talk about the central bank, right? The Federal Reserve, and cutting the short-term interest rate, right? And this year, the Federal Reserve has already planned on, they've expressed in their meetings that they're planning on tightening their monetary policy, or in other words, they're thinking about hiking the short-term interest rate, or the federal funds rate. And in 2021, you can see that the federal funds rate, short-term interest rate, that was pretty much set at zero since March of 2020. They cut that down to zero to say, hey, we want to make borrowing as cheap as possible for not only corporations, but also for mortgage rates, auto loans. And that in turn caused a lot of the inflation we talked about. Now, that's created a problem, and they're trying to answer that problem. So looking at this graph here, by the end of 2022, you have several federal open market committee members. Think about these people as people that sit on the Federal Reserve Board. They're expecting interest rates to hit 1% by the end of 2022, right? That's 4 rate hikes. And you can see that direction is continuous up until 3 years, 4 years down the road. We're expecting to price in some more rate hikes, interest rate hikes. So I don't know, Blake, what does that kind of tell you about what the Fed's planning on doing?
I think it's, in some cases, just stopping what is causing the inflationary pressures, and in other cases, it's activating tools in the toolkit in order to stave off runaway inflation. So the things like transfer payments, stimulus payments, mortgage-backed bond purchases, whether it's a taper and a slowdown of some of those things, or just an outright stop. That's one way to go about reducing inflationary pressure. The other is to forecast your hand about what we intend to do about rates, which creates like a signal to the market of like, hey, don't get too carried away with risk and investment and et cetera, to try and steer people's behavior in all things, and specifically in this case with risk taking. So obviously, interest rates rising puts different types of pressure on different asset classes. You're seeing it really play out right now with like non-profitable tech companies, where their entire kind of value is earnings that are generated in the future pulled forward to today. And so those are getting hit the hardest. But I think you've probably heard me equate it to before, just turning the burner down on the stovetop. We're boiling a pot of macaroni, starting to boil over. The easiest thing to do is just temperature control. So first, it's forecasting, your willingness to do this with the dot plot and your expectation set. Then it's actually having the courage to do so. So you're going to hear a lot of like finger pointing between the fiscal side and the monetary side, between Congress and the president and the Federal Reserve, saying whose responsibility is it to stave off inflation. And at the end of the day, that is the Fed mandate, right? Is healthy levels of inflation. So you're going to look to them to change up the bond buying programs, other stimulus measures, and then certainly by just having a more normal Fed funds rate, which will hit every single one of us in the way we borrow, auto loans, personal loans, mortgages, et cetera. But it's, this again is not a surprise. We traded this inflationary pressure for a deeper recession or potentially even an economic winter. And now we've got to pay for it with rising rates. So I won't be surprised if this plays out exactly as it's projected. However, the future is unknowable. So maybe they get midway into the rate cycle hike. and things cool off too quickly, then what do? You reverse course. I mean, that is the Fed toolbox, I guess concisely, or not very concisely.
We'll have to see if they keep with these rate hikes, and we'll keep an eye on where interest rate goes. But definitely you'll be hearing from us as the Fed continues their monetary policy actions. And to cap it off, we wanted to talk a little bit more about kind of the growth versus value dilemma. So, for a long time, the same way you've heard Blake kind of talk about emerging markets in China, you've also heard him talk about value, right? Being a value proponent. But I mean, it's been a tough place to be for you over the past 5 years, I assume.
Yeah. And I'm not alone. I mean, there's plenty of investors out there that have kind of hung their hat on value investing. I don't have to name them. There are plenty. And I often turn to them to kind of think of ways to investigate, at least be critical of one's pre-existing beliefs around, is the value factor dead? Does cash flow matter? Do earnings matter? And unfortunately, that answer can be, conflating or can escape you for years and years on end. So in another year of value underperforming growth, we were talking to our asset managers, talking to our partners, like how do we shape the narrative? How do we think through value on a go-forward basis here in the United States versus overseas? And it's not something to where we ever expect value to like have that inflection and outperform for a quarter at a time and then inflect back. These are more so structural things that happen with the market that they prove to work. Then the market becomes aware, fund flows chase, and it usually plays out over several years' time, which is really what we've been building towards. Whether you look at our overweight to value factor, whether you look at our willingness to own cheaper overseas securities, we are waiting for that inflection or that market rotation.
Yeah.
So the chart you put up is a measure of the earnings to price yield. So you want to think of it as the amount a particular market is generating in profit relative to the price you pay. So it's just the price to earnings ratio flipped upside down. And then this is a measure of that earnings to price ratio for the top decile of cheapest stocks in that particular market. So what you'll notice, the black line going back to the early 90s is international stocks. And the blue line is, I guess it's green. Am I colorblind?
It's a mix of, no wrong answer.
Blue, green, aqua. My wife would kill me for not knowing what exact color that is. But you'll notice that, the EP ratio, the earnings to price ratio for value stocks in the US is as cheap as it's been ever, right? Cheaper than they even were flashing, in the Great Recession or in the tech bubble. International stocks, almost close to the same story. They were slightly cheaper in the late 1990s when no one really wanted anything to do with international stocks because US was all the rage, specifically US tech. Kind of true, now as well. So just taking that into consideration, this isn't something that's happened overnight. Value has been getting cheaper, structurally cheaper year over year over year. And that's not something you expect to just be able to time the bottom on, right? So it's important to remind yourself when you have this conviction that I'm not expecting to get paid for it over the next 6 months, over the next 12 months. I'm going to continue to build my position. I'm going to rebalance into my position. I'm going to position size appropriately so that if I'm wrong, it's not, ruinous to my financial plan. But when you're right, also don't go running for the exits when you have one good quarter or 2 good quarters or something like that. Expect to be paid out on it. So on this chart here as well, you'll notice that, looking at the last time value being this cheap was kind of flashing in front of our eyes coming out of the tech bubble. Fast forward 5 years from the tech bubble popping, how well did value do in the US? How well did value do internationally? So, US value, just as an example, from January 1st, 2000 through December 31st, 2004, compounded at about 20.5% versus the market at large in the US, or at least large cap companies, down 1.7%. It's about 21% delta in performance. Actually, I think that's about 22%, don't tell anybody. And then internationals, relatively the same story, about a 15% delta in annual compounded performance over 5 years. So if you've been looking at a growth and value chart over the last 5 years or the last 10 years, and you see, tens and hundreds of percent in divergence performance, and you're left wondering, why in the world have I owned anything but growth? The answer is because sometimes these things play out for longer than we expect, and there are artificial pressures that make them play out for longer than we expect. But once the market starts to care about profitability and free cash flow and earnings and all of these things, and the bid is so stretched and unrealistic, things start to go the other direction. And I do believe we're at or near an inflection in that regard. So, looking forward, do I think the next 5 to 10 years looks more like 1995 to 2000, where tech reigned and growth reigned? Or does it look more like 2000 to 2005? I would beg the latter. And I'm hanging my hat on that. I certainly have been, and I've been wrong for a couple of years. But value, it is cheap, cheap, cheap.
It is,
regardless of how you sketch it up, measure it, et cetera. So that's my rally cry.
Yeah, I was going to say the same thing where you shared comments about, hey, 2000 to 2005 for the next 5 years. Your starting point is pretty much when the dot-com bubble burst. And I'm not saying that, hey, today you're going to see a similar size drawdown to the dot-com bubble, but I feel like there are some similar traits where in the year 2000, a lot of these growth and tech companies had their valuations get way more outstretched than what their fundamentals actually shown for. And that's kind of similar with some of the growth names that we see today, right?
Yep.
So that's why I share your sentiment about why we could possibly be seeing some type of resemblance between the years 2000 to 2005 over these next 5 years.
Yep.
The last comment I wanted to share was just, I don't know if you heard this, but I was listening to a podcast and they said that Cathie Wood said something similar to the lines of value is a bubble, or we're in the value bubble. And I don't know what you make of that, but I got to tell you that these charts show you how cheap value is. And to me, that's a sign that there isn't that type of bubble.
I don't envy Cathie's position. She had tremendous success and really impressive results over a couple of years' time. And I think she's incredibly skilled. Obviously, luck also plays into everything we do in investing, of just fortunate timing. And to be a really growthy investor in a hyper kind of speculative market where rates are super, super cheap and COVID at home narrative and all this stuff, like she was perfectly positioned for that. Going forward, I think investing into those names that are potentially over levered or non-profitable, maybe don't even have like full market traction or addressable market at this point. Those companies will really struggle like we're seeing right now, and they'll start to get rolled up and acquired and sold off or shuttered, who knows. And again, I'm not a forecaster, but would I rather be a hyper speculative growth investor over the next 3 to 5 years, or as rates rise, looking for durable companies that produce meaningful profits with consistency, with a moat, and geographically diversified and all of these things. So we are not grave dancing on Cathie Wood and ARK by any means. But at the same time, we've seen clients chase that kind of stuff, of the FOMO kind of narrative playing out in front of our eyes. And we understand when you're underperforming and you're not getting rewarded for the risks that you're taking, and you see it happening somewhere else, that is very attractive and enticing, and it's playing tricks on your brain. But sticking to tried and true kind of merits of fundamental investing over time, and caring about cash flow and free cash flow and earnings, we have to apply that same kind of patience with the managers that we hire, right? When we hire them with the mandate of, you buy developed international companies, and you look for the top decile of undervalued companies that have strong cash flow but are priced below their intrinsic value, and they do that, but the market doesn't reward them for it because value is just underperforming generally, we can't assign blame to them. They're doing exactly what we paid them to do. If we hired them to do X and they did Y and underperformed, a whole different kind of ballgame of accountability. So we're doing what we say we do, we're going to do, and we're trying to stay principled in that. Because if we're constantly just changing and moving from philosophy to philosophy, you're always chasing that hot. Right. Shout out to the last word on the street episode. We can't be reactive because you're always going to be buying the stuff that's rich and expensive, and selling the stuff that's weak and probably worth another look, to be quite honest.
Definitely. But I think you said it all. That's going to be our year in review, and also what we're looking at for the year ahead. So thank you everyone for tuning in, and we all hope you have a great day.
Thank you everyone. Take care.